Question 1. Benchmark analysis indicates that when implementing fidelity bonding for specific roles within an organization, a key consideration is how to best structure coverage to protect against employee dishonesty. Considering the principles of position schedule bonds, which approach most effectively aligns with regulatory expectations for ensuring adequate protection against potential losses arising from the duties of designated positions. Option A. Setting the bond limit for each position based on the perceived trustworthiness and length of service of the individual currently occupying that role. Option B. Selecting a blanket bond limit that applies equally to all positions, regardless of their varying levels of financial access or authority. Option C. Establishing the bond limit for each position based on an assessment of the maximum potential loss that could arise from the duties and access associated with that specific position, irrespective of the individual employee. Option D. Relying solely on the insurance broker's recommendation for bond limits without independently verifying the coverage against the specific risks of each position. The correct answer is A. Setting the bond limit for each position based on the perceived trustworthiness and length of service of the individual currently occupying that role. Explanation. This scenario is professionally challenging because it requires a nuanced understanding of how fidelity bonds are structured to protect against employee dishonesty, specifically when coverage is tied to the responsibilities of a particular role rather than an individual. The core difficulty lies in accurately assessing the potential for loss associated with a position and ensuring that the bond's limits are adequate for the risks inherent in that role, even if the individual occupying it changes. Careful judgment is required to avoid underinsurance, which leaves the employer exposed, or overinsurance, which leads to unnecessary premium costs. The correct approach involves selecting a position schedule bond, where the limit of liability is set based on the maximum potential loss that could arise from the duties and access of a specific position, irrespective of the employee currently holding it. This aligns with the principle of fidelity bonding, which is to indemnify the insured against losses caused by the fraudulent or dishonest acts of their employees. Regulatory frameworks, such as those governing insurance and financial services, emphasize the importance of adequate coverage that reflects the risk profile of the insured entity and its operations. A position schedule bond, by its nature, addresses this by focusing on the inherent risks of the role, ensuring that as employees change, the coverage remains relevant to the position's potential for causing loss. This approach is ethically sound, as it prioritizes the employer's financial security against employee dishonesty in a systematic and risk-based manner. An incorrect approach would be to simply select a bond limit based on the current employee's perceived trustworthiness or tenure. This fails to acknowledge that dishonesty can arise from any individual, regardless of their background, and that the risk is tied to the position's access and authority. This approach is ethically deficient as it prioritizes a potentially subjective and unreliable assessment over a structured risk management strategy. It also fails to meet the regulatory expectation of ensuring that insurance products are designed to provide meaningful protection against the risks they purport to cover. Another incorrect approach would be to choose a blanket limit for all positions without considering the varying levels of financial access or decision-making authority inherent in different roles. This is problematic because it does not adequately address the specific risks associated with positions that handle larger sums of money or have greater control over assets. Such an approach could lead to underinsurance for high-risk positions, leaving the employer vulnerable to significant losses, and overinsurance for low-risk positions, resulting in wasted premium. This is a failure of risk assessment and does not align with the principles of prudent insurance placement. A further incorrect approach would be to rely solely on the advice of a broker without independently verifying that the proposed position schedule bond accurately reflects the potential losses associated with each designated position. While brokers provide valuable expertise, the ultimate responsibility for ensuring adequate coverage rests with the insured. Failing to conduct due diligence on the bond structure and limits, particularly in relation to the specific duties of each position, can lead to a false sense of security and leave the organization exposed. This is a failure in professional due diligence and risk management. The professional decision-making process for similar situations should involve a thorough assessment of each position's responsibilities, the financial assets or information they have access to, and the potential for loss if those assets are misappropriated or misused due to dishonest acts. This assessment should inform the selection of appropriate bond types and limits. Professionals should actively engage with their insurance providers and brokers to ensure that the chosen coverage is specifically tailored to the identified risks, rather than relying on generic or overly simplistic solutions. A proactive and informed approach to risk management is paramount. Question 2. The control framework reveals a claim for financial loss allegedly stemming from an employee's fraudulent manipulation of inventory records, leading to the company overpurchasing raw materials. The policy's insuring agreement covers direct loss resulting from employee dishonesty. However, the loss claimed is primarily the carrying cost of excess inventory and potential obsolescence, rather than the direct cost of the overpurchased materials themselves. Which approach best aligns with the Fidelity bonding principles regarding exclusions for specific losses not covered? Option A. Cover the claim, as the loss is a direct financial consequence of the employee's dishonest act of manipulating inventory records. Option B. Deny the claim, as the loss represents consequential or indirect damages, carrying costs, obsolescence, and not a direct loss of money or property as typically contemplated by Fidelity bond insuring agreements. Option C. Partially cover the claim, by reimbursing the direct cost of the overpurchased materials but excluding the carrying costs and potential obsolescence. Option D. Cover the claim, as the employee's dishonesty is the root cause, and Fidelity bonds are intended to cover all losses arising from employee malfeasance. Correct answer is A. Cover the claim, as the loss is a direct financial consequence of the employee's dishonest act of manipulating inventory records. Explanation. This scenario presents a professional challenge because it requires a nuanced understanding of Fidelity bond exclusions, specifically concerning losses arising from employee dishonesty that are not directly tied to the enumerated perils. The difficulty lies in distinguishing between a loss that is a direct consequence of a covered dishonest act and one that is an indirect or consequential loss, which is often excluded. Careful judgment is required to interpret the policy wording and apply it to the specific facts of the loss. The correct approach involves a thorough review of the Fidelity bond policy's exclusion clauses, particularly those pertaining to consequential or indirect losses, and comparing them against the documented evidence of the employee's dishonest acts and the resulting financial impact. This approach is correct because Fidelity bonds are contracts of indemnity, meaning they cover direct financial losses resulting from specific perils, such as employee dishonesty. Exclusions are designed to limit the insurer's liability to these direct losses. By focusing on whether the loss is a direct and proximate result of the dishonest act, as opposed to a secondary or consequential outcome, one adheres to the fundamental principles of insurance and the specific terms of the Fidelity bond. This aligns with the regulatory expectation that insurance policies are interpreted according to their plain language and that exclusions are applied as written, provided they are not ambiguous or contrary to public policy. An incorrect approach would be to assume coverage for any loss where an employee's dishonest act can be identified as a contributing factor, without rigorously assessing the directness of the loss. This fails to acknowledge the contractual limitations of the Fidelity bond and the specific wording of exclusion clauses. Such an approach risks misinterpreting the scope of coverage and could lead to claims being paid that are outside the policy's intent, potentially violating principles of sound underwriting and actuarial principles that underpin premium calculations. Another incorrect approach would be to deny coverage solely based on the absence of explicit mention of the specific type of loss in the policy's insuring agreement, without considering whether the loss is a direct consequence of a covered peril. This overlooks the fact that Fidelity bonds are designed to cover losses arising from covered perils, and the focus should be on the causal link between the peril and the loss, rather than a specific enumeration of every possible loss scenario. This can lead to an overly restrictive interpretation of the policy, potentially leaving the insured exposed to losses that were reasonably within the contemplation of the Fidelity bond. A third incorrect approach would be to interpret exclusions broadly to encompass any loss that might be perceived as a business risk, even if directly caused by employee dishonesty. This misapplies the concept of business risk, which is generally not covered by Fidelity bonds, by conflating it with losses that are specifically indemnified under the policy. Fidelity bonds are intended to protect against losses from internal fraud and dishonesty, not general market fluctuations or operational inefficiencies. The professional decision-making process for similar situations should involve a systematic review of the Fidelity bond policy, paying close attention to both the insuring agreements and the exclusion clauses. This should be followed by a detailed factual investigation to establish the direct causal link between the alleged dishonest act and the claimed loss. When interpreting ambiguous terms, the principle of contra pro frentem, interpreting against the party that drafted the contract, may be considered, but the primary focus should remain on the plain meaning of the policy language and the intent of the parties at the time of underwriting. Consultation with legal counsel or claims specialists experienced in fidelity bonding may be necessary for complex cases. Question 3. Cost-benefit analysis shows that implementing enhanced internal controls and pursuing legal action against a former employee who engaged in fraudulent activities would incur significant upfront expenses. However, the insured entity believes these measures are necessary to recover funds and prevent future losses. The Fidelity bond policy defines loss as direct financial loss resulting from employee dishonesty. Considering the direct loss requirement, which of the following best reflects the eligible claim under the Fidelity bond? Option A. The cost of implementing new security systems and hiring additional compliance staff to prevent future incidents. Option B. The projected lost profits resulting from the disruption caused by the employee's fraudulent activities. Option C. The legal fees and expenses incurred in pursuing civil litigation against the former employee to recover the misappropriated funds. Option D. The direct amount of funds demonstrably misappropriated by the employee, as evidenced by financial records. The correct answer is D. The direct amount of funds demonstrably misappropriated by the employee, as evidenced by financial records. Explanation. This scenario presents a professional challenge because it requires a firm understanding of the direct loss requirement in fidelity bonding, specifically how it applies to indirect or consequential damages. The challenge lies in distinguishing between losses that are a direct and immediate consequence of the bonded employee's fraudulent act and those that are secondary or speculative. Careful judgment is required to ensure that only eligible losses are claimed under the fidelity bond, adhering strictly to the policy's terms and conditions and relevant regulatory guidance. The correct approach involves meticulously examining the causal link between the employee's misconduct and the financial detriment suffered by the insured. This requires identifying losses that are a direct, quantifiable, and immediate result of the fraudulent act. For instance, if an employee embezzles funds, the direct loss is the amount of money stolen. This aligns with the principle that fidelity bonds are designed to cover losses directly caused by employee dishonesty, not broader business disruptions or lost opportunities that might arise indirectly. Regulatory frameworks for fidelity bonding typically emphasize this direct loss principle to prevent overclaiming and to ensure the bond's purpose is met. An incorrect approach would be to include losses that are speculative or consequential. For example, claiming lost profits due to a disruption in business operations caused by the employee's actions, or the cost of increased security measures implemented after the discovery of the fraud, would likely fall outside the direct loss requirement. These are indirect consequences, not the immediate financial impact of the dishonest act itself. Such an approach would fail to adhere to the contractual obligations of the fidelity bond and could be seen as misrepresenting the nature of the loss to the insurer, potentially violating regulatory principles of good faith and fair dealing. Another incorrect approach would be to claim losses that are not quantifiable or are based on estimations rather than concrete financial records. Fidelity bonds require demonstrable proof of loss. Attempting to claim losses that cannot be precisely calculated or are based on hypothetical scenarios would be a failure to meet the evidential requirements and the direct loss principle. This could lead to claim denial and potential regulatory scrutiny for submitting unsubstantiated claims. The professional decision-making process for similar situations should involve a thorough review of the fidelity bond policy wording, particularly the definitions of loss and direct loss. It requires gathering all relevant financial documentation to substantiate the claimed losses and critically assessing the causal relationship between the employee's misconduct and each component of the claimed loss. Consulting with legal counsel or claims specialists experienced in fidelity bonding can also provide valuable guidance in navigating complex claim scenarios and ensuring compliance with regulatory requirements and policy terms. Question 4. The evaluation methodology shows that a company has engaged a consultant who operates through their own limited company, invoices the client for services rendered, and provides their own equipment. However, this consultant works exclusively for the client, adheres to the client's internal working hours and procedures, and is integrated into the client's project teams. Under the Fidelity Bonding Principles Certificate Framework, which of the following best describes the approach to determining if this consultant should be considered an employee for Fidelity bond purposes? Option A. Rely on the consultant's self-declaration of being an independent contractor as the definitive factor for exclusion from employee classification. Option B. Classify the consultant as an employee if their working arrangement exhibits a high degree of control by the client, integration into the business, and dependency, irrespective of their self-employment status or invoicing method. Option C. Classify the consultant as an employee only if they are directly on the company's payroll and receive a P60. Option D. Exclude the consultant from employee classification solely because they operate through their own limited company and issue invoices. The correct answer is B. Classify the consultant as an employee if their working arrangement exhibits a high degree of control by the client, integration into the business, and dependency, irrespective of their self-employment status or invoicing method. Explanation. This scenario presents a common implementation challenge in fidelity bonding, accurately defining who constitutes an employee for the purpose of coverage. The challenge lies in distinguishing between individuals who are clearly employees, those who are clearly independent contractors, and those in a gray area where their relationship with the company might blur the lines. Misclassification can lead to significant financial and legal repercussions for the employer, including underpayment of premiums, denial of claims, and potential regulatory penalties. Careful judgment is required to ensure that the fidelity bond accurately reflects the company's workforce and protects against employee dishonesty. The correct approach involves a thorough review of the contractual relationship and the actual working conditions of the individual in question, applying the definitions and criteria established by relevant UK employment law and the specific terms of the fidelity bond policy. This means looking beyond the title or self-designation of the individual and assessing factors such as control over work, provision of equipment, opportunity for profit or loss, and integration into the business. If the individual's working arrangement aligns with the legal definition of an employee in the UK, they should be included in the employee count for fidelity bond purposes. This ensures compliance with the principle of accurate representation to the insurer and provides appropriate coverage for potential losses caused by dishonest acts of all individuals acting in an employee capacity. An incorrect approach would be to solely rely on the individual's self-classification as an independent contractor, regardless of the actual nature of their work. This fails to acknowledge the legal definitions of employment in the UK and the insurer's reliance on accurate information to underwrite the bond. Another incorrect approach is to exclude individuals based solely on the fact that they are paid through a different payroll system or receive a different tax treatment, without a deeper analysis of the control and dependency factors inherent in their working relationship. This overlooks the substance of the employment relationship, which is paramount in legal and insurance contexts. A further incorrect approach is to assume that if an individual is not on the company's direct payroll, they cannot be considered an employee for fidelity bond purposes. This is a simplistic view that ignores the possibility of de facto employment, where an individual is integrated into the business and subject to its control, even if their formal employment status is ambiguous. Professionals should adopt a decision-making framework that prioritizes a comprehensive understanding of UK employment law and the specific terms of the fidelity bond. This involves 1. Gathering all relevant information about the individual's working relationship, including contracts, payment structures, and day-to-day activities. 2. Consulting with legal counsel or HR experts to interpret UK employment law in relation to the specific facts. 3. Carefully reviewing the fidelity bond, policy's definitions and exclusions. And 4. Making a determination based on the substance of the relationship, rather than superficial labels, to ensure accurate coverage and compliance. Question 5. The audit findings indicate a potential vulnerability in the firm's internal controls related to the handling of client assets, suggesting that current fidelity bond coverage may not fully address the identified risks. Which of the following actions best aligns with the principles of regulatory compliance and prudent risk management as outlined in the Fidelity Bonding Principles Certificate Syllabus? Option A. Assume the current Fidelity bond coverage is sufficient, as the firm has not experienced any direct losses from employee dishonesty to date. Option B. Increase the Fidelity bond limit significantly without a detailed review of the policy's terms and conditions to ensure the increased coverage addresses the specific audit concerns. Option C. Rely on assurances from department heads that their teams are operating with integrity and that no fraudulent activity is suspected. Option D. Immediately review the firm's existing Fidelity bond policy to assess its adequacy against the specific risks highlighted by the audit, considering coverage limits, exclusions, and the scope of protection for client assets. The correct answer is D. Immediately review the firm's existing Fidelity bond policy to assess its adequacy against the specific risks highlighted by the audit, considering coverage limits, exclusions, and the scope of protection for client assets. Explanation: this scenario is professionally challenging because it requires the firm to balance its contractual obligations to its clients with the regulatory requirements of fidelity bonding. The audit findings highlight a potential gap in controls that could expose the firm and its clients to financial loss due to employee dishonesty. Navigating this requires a thorough understanding of the Fidelity Bonding Principles Certificate syllabus, particularly concerning regulatory compliance and the scope of coverage. The correct approach involves a proactive and comprehensive review of the firm's existing fidelity bond coverage against the specific risks identified by the audit. This means assessing whether the current policy adequately covers the types of employee misconduct that could lead to financial loss, the limits of liability are sufficient, and that all relevant personnel are included. This approach is correct because it directly addresses the identified control weaknesses and aligns with the principle of ensuring adequate protection for clients and the firm, as mandated by regulatory frameworks governing financial services and fidelity bonding. It demonstrates a commitment to regulatory compliance and client protection, which are core tenets of the Fidelity Bonding Principles Certificate. An incorrect approach would be to dismiss the audit findings without a thorough investigation, assuming the current coverage is sufficient. This fails to acknowledge the potential for unforeseen risks and neglects the duty to ensure robust controls. Such an approach could lead to regulatory breaches if the existing coverage is indeed inadequate, exposing the firm to significant financial and reputational damage. Another incorrect approach would be to only consider increasing the bond limit without reviewing the policy's specific exclusions and conditions. Fidelity bonds are not a blanket guarantee against all losses. Their effectiveness depends on the precise wording of the policy. Failing to scrutinize these details means the increased limit might not cover the actual risks identified, rendering the action ineffective from a risk mitigation perspective and potentially non-compliant with the spirit of regulatory oversight. A further incorrect approach would be to rely solely on internal assurances from employees that no fraudulent activity has occurred or is likely to occur. While internal controls are important, audit findings suggest a need for external validation and a review of the insurance coverage itself. This approach overlooks the fundamental purpose of fidelity bonding, which is to protect against the possibility of dishonesty, regardless of current perceptions. The professional reasoning process for similar situations should involve 1. Acknowledging and thoroughly investigating all audit findings. 2. Consulting the relevant regulatory framework and the Fidelity Bonding Principles Certificate syllabus to understand obligations. 3. Conducting a detailed review of existing fidelity bond policies, including coverage, limits, exclusions, and conditions. 4. Assessing the identified risks against the policy's provisions to determine any gaps. 5. Implementing necessary adjustments to coverage or internal controls to ensure compliance and adequate protection. 6. Documenting all steps taken and decisions made. Question 6. Process analysis reveals a situation where a financial institution has submitted a fidelity bond claim for a significant inventory shortage. The institution's internal investigation suggests the shortage is due to a combination of factors, including potential employee pilferage, but also acknowledges market-driven price fluctuations that have devalued the inventory and some administrative errors in stock-taking. The institution is also seeking to recover potential future business losses stemming from the disruption caused by the shortage. Which approach best navigates the exclusions for inventory shortages, trading losses, and indirect losses under a standard fidelity bond? Option A. Deny the entire claim, citing the presence of market-driven price fluctuations and administrative errors as sufficient reasons to exclude any loss related to inventory shortages, and disregard the potential for employee pilferage. Option B. Investigate thoroughly to determine the quantifiable loss directly attributable to proven employee dishonesty, excluding any portion of the shortage caused by market fluctuations or administrative errors, and disallow the claim for future business losses as they constitute indirect losses. Option C. Interpret trading losses broadly to encompass the market-driven price fluctuations, and therefore deny the entire claim, including any portion that might be attributable to employee dishonesty, while also rejecting the claim for future business losses. Option D. Process the claim for the full inventory shortage, assuming employee pilferage is the primary cause, and include the estimated future business losses as part of the claim. The correct answer is D. Process the claim for the full inventory shortage, assuming employee pilferage is the primary cause, and include the estimated future business losses as part of the claim. Explanation: this scenario presents a professional challenge because it requires a firm understanding of the specific exclusions within a Fidelity bond policy, particularly concerning inventory shortages, trading losses, and indirect losses. The challenge lies in accurately distinguishing between a loss directly attributable to employee dishonesty, covered by the bond, and losses arising from market fluctuations, operational inefficiencies, or other factors not directly caused by fraudulent acts. Misinterpreting these exclusions can lead to incorrect claims processing, financial repercussions for the insured and the insurer, and potential regulatory breaches. The correct approach involves meticulously reviewing the Fidelity bond policy wording to ascertain if the inventory shortage is a direct result of employee theft or fraud, as opposed to other causes like spoilage, obsolescence, or administrative errors. If the shortage is demonstrably linked to dishonest acts covered by the policy, the claim should proceed. This aligns with the principle that Fidelity bonds are designed to protect against financial loss due to employee dishonesty, not general business risks. Regulatory frameworks for insurance, such as those governing claims handling and policy interpretation, mandate that insurers act in good faith and adhere strictly to the terms and conditions of the policy. Therefore, a thorough investigation to establish the direct causal link between employee dishonesty and the inventory shortage is paramount. An incorrect approach would be to automatically deny the claim solely because it involves an inventory shortage. This fails to acknowledge that inventory shortages can, in some circumstances, be a direct consequence of employee theft, which is a covered peril. Denying the claim without a proper investigation into the cause of the shortage would be a failure to adhere to the policy's intent and could violate regulatory requirements for fair claims handling. Another incorrect approach would be to assume that any loss described as a trading loss is automatically excluded. Many Fidelity bonds exclude speculative trading losses. They may still cover losses directly resulting from an employee's fraudulent trading activities that were designed to conceal theft or misappropriate assets. A blanket exclusion without considering the specific context and the employee's intent would be a misapplication of the exclusion. Furthermore, treating an indirect loss as a direct loss covered by the bond is also an incorrect approach. Fidelity bonds typically cover direct financial losses. For example, if an employee's fraudulent activity leads to a temporary disruption in operations, causing a loss of future business, this would generally be considered an indirect or consequential loss and would likely fall outside the scope of the bond's coverage unless specifically endorsed. Failing to differentiate between direct and indirect losses and attempting to claim for the latter demonstrates a misunderstanding of the bond's purpose and limitations. The professional decision-making process for similar situations should involve a systematic review of the claim against the specific policy wording. This includes 1. Understanding the nature of the loss and its alleged cause. 2. Identifying relevant policy clauses, particularly exclusions. 3. Conducting a thorough investigation to gather evidence supporting or refuting the alleged cause of loss. 4. Applying the policy terms and exclusions to the gathered evidence, with a focus on direct causation. 5. Consulting with legal counsel or subject matter experts if the interpretation of policy terms or the evidence is complex. 6. Communicating the decision clearly and transparently to the insured, referencing the specific policy provisions. Question 7. Stakeholder feedback indicates that the current background screening procedures for new hires may not be sufficiently robust to mitigate Fidelity risks effectively. Considering the regulatory framework for Fidelity bonding principles, which of the following approaches to background screening would be most appropriate for a financial services firm? Option A. Mandate a full credit report for every applicant, regardless of the role's responsibilities or potential for financial exposure, to assess their financial discipline. Option B. Implement a comprehensive screening process that includes verification of employment history, relevant criminal record checks where legally permissible, and financial probity assessments for roles with significant financial responsibilities. Option C. Rely primarily on extensive social media monitoring for all prospective employees to gauge their general character and suitability for the firm. Option D. Conduct only basic identity verification and a cursory review of professional qualifications, assuming that all individuals are trustworthy until proven otherwise. The correct answer is B. Implement a comprehensive screening process that includes verification of employment history, relevant criminal record checks where legally permissible, and financial probity assessments for roles with significant financial responsibilities. Explanation: this scenario is professionally challenging because it requires balancing the need for thorough background screening with the principles of fairness, data privacy, and regulatory compliance. The firm must ensure it meets its obligations under the relevant regulatory framework to protect against fidelity risks without infringing on the rights of potential employees or creating undue administrative burdens. Careful judgment is required to select screening methods that are both effective and legally permissible. The correct approach involves a multifaceted background screening process that is proportionate to the role's responsibilities and potential for loss. This includes verifying employment history, checking for criminal records where legally permissible and relevant, and assessing financial probity for roles with significant financial exposure. This approach is justified by the regulatory framework's emphasis on due diligence in hiring to mitigate fidelity risks. It aligns with the principle of know your customer and know your employee by seeking to understand an individual's past conduct that could indicate a propensity for dishonest behavior. Ethical considerations also support this, as it demonstrates a commitment to safeguarding client assets and maintaining the integrity of the financial services industry. An approach that relies solely on credit checks for all positions is incorrect, because it may not be relevant to the specific fidelity risks associated with certain roles, and could be considered an invasion of privacy or discriminatory if not carefully managed. Furthermore, it might not uncover all relevant fidelity risks. An approach that skips criminal record checks entirely for roles with significant access to client funds or sensitive information would be a regulatory failure, as it neglects a key indicator of potential dishonesty. Conversely, an approach that conducts overly intrusive or irrelevant checks, such as extensive social media monitoring beyond what is legally permissible and directly related to job suitability, would also be ethically and potentially legally problematic, violating data protection principles and potentially leading to unfair hiring decisions. Professionals should adopt a decision-making framework that begins with understanding the specific fidelity risks associated with each role. This involves mapping the potential for loss or misconduct to the responsibilities and access granted to the individual. Subsequently, they should identify screening methods that are legally permissible, proportionate to the identified risks, and aligned with ethical best practices regarding privacy and fairness. Regular review and updating of screening policies are also crucial to ensure ongoing compliance and effectiveness. Question 8. The audit findings indicate that a significant misappropriation of funds occurred during the previous policy period, but the discovery of this loss was only made recently, after the current Fidelity bond policy had already commenced. Given this timeline, what is the primary factor that determines whether a claim for this loss would be covered under the current Fidelity bond? Option A. Whether the insured can prove the perpetrator is no longer employed by the company. Option B. Whether the loss event itself occurred during the current policy period. Option C. Whether the loss was discovered within the discovery period specified in the current Fidelity bond policy. Option D. Whether the total amount of the loss exceeds the policy's deductible. The correct answer is C. Whether the loss was discovered within the discovery period specified in the current Fidelity bond policy. Explanation: scenario analysis. This scenario is professionally challenging because it requires a nuanced understanding of the discovery period's implications for a Fidelity bond claim. The auditor's findings highlight a potential gap in coverage due to the timing of the discovery relative to the policy's discovery period. This necessitates careful judgment to determine if a claim, if filed, would be valid under the bond's terms and relevant regulations, particularly concerning the insured's obligation to report discovered losses within the specified timeframe. Correct approach analysis. The correct approach involves a thorough review of the Fidelity bond policy's discovery period clause and the specific circumstances of the discovered loss. This requires understanding that the discovery period dictates the timeframe within which a loss, even if it occurred earlier, must be discovered and reported to the insurer to be covered. The insured must demonstrate that the loss was discovered within the policy's discovery period, or within an extended discovery period if purchased. This aligns with the principle that Fidelity bonds cover losses discovered during the bond period or within a specified discovery period following termination, provided the loss occurred during the bond period. The regulatory framework for Fidelity bonding emphasizes clear contractual terms and the insured's responsibility to adhere to policy conditions, including reporting requirements. Incorrect approaches analysis. One incorrect approach would be to assume coverage simply because the loss occurred during the policy period, without considering the discovery date. This fails to acknowledge the critical function of the discovery period as a condition precedent to coverage for discovered losses. It ignores the insurer's right to be notified within a defined timeframe, allowing them to investigate and mitigate further losses. This approach violates the contractual obligations of the Fidelity bond and the regulatory expectation that policy terms are adhered to. Another incorrect approach would be to dismiss the claim solely because the loss event predates the current policy period, without verifying if the discovery itself falls within the applicable discovery period. Fidelity bonds often cover losses that occurred during the policy period but were discovered during the discovery period. Focusing only on the loss occurrence date rather than the discovery date misinterprets the coverage trigger for discovered losses. This overlooks the specific wording and intent of the discovery clause, which is designed to protect the insurer from stale claims. A third incorrect approach would be to rely on general insurance principles without consulting the specific Fidelity bond policy and its governing regulations. Fidelity bonds have unique characteristics, and their coverage, including the discovery period, is strictly defined by their terms and conditions. Generic interpretations can lead to incorrect assessments of coverage validity and potential disputes. This approach lacks the necessary specificity required by the regulatory framework governing Fidelity bonds. Professional reasoning. Professionals should approach such situations by first meticulously examining the Fidelity bond policy's discovery period clause. This involves understanding the policy's inception date, termination date, and any specified discovery period. Next, they must ascertain the exact date the loss was discovered by the insured and compare this to the policy's discovery period. If the discovery falls within the specified period, further investigation into the loss occurrence and reporting is warranted. If the discovery falls outside the period, coverage is likely excluded, and this should be communicated clearly, referencing the specific policy provisions and relevant regulatory guidance on policy interpretation and claim handling. This systematic approach ensures adherence to contractual obligations and regulatory compliance. Question 9. The assessment process reveals that a Fidelity bond claim submitted by a small business for losses due to employee theft has been denied by the insurer. The insured believes the denial is based on a misinterpretation of the policy's discovery period clause and wishes to pursue legal recourse. Which of the following actions represents the most appropriate and professionally sound initial step for the insured to take? Option A. Immediately file a lawsuit against the insurer in civil court to compel payment of the claim. Option B. Accept the insurer's decision and seek a new Fidelity bond from a different provider without further challenge. Option C. Publicly post negative reviews of the insurer on social media platforms to pressure them into reconsidering the claim. Option D. Formally notify the insurer in writing of the dispute, referencing the specific policy clause in question, and requesting a review of the denial, potentially proposing mediation. Correct answer is A. Immediately file a lawsuit against the insurer in civil court to compel payment of the claim. Explanation. This scenario presents a professional challenge because it involves a dispute over the interpretation of a Fidelity bond's coverage, directly impacting the financial security of the insured party and the reputation of the insurer. Navigating such disputes requires a thorough understanding of the policy's terms, relevant legal precedents, and the established dispute resolution mechanisms. The core of the challenge lies in balancing the insurer's obligation to uphold the bond's terms with the insured's right to seek redress for perceived losses. Careful judgment is required to ensure that any resolution is fair, legally sound, and adheres to the principles of fidelity bonding. The correct approach involves initiating the formal dispute resolution process as outlined in the Fidelity bond policy. This typically begins with a formal notification of the dispute to the insurer, followed by a period of negotiation or mediation. If these steps fail, the policy will usually stipulate a path towards arbitration or litigation. This approach is correct because it respects the contractual agreement between the parties, which explicitly defines how disagreements will be handled. Adhering to the policy's dispute resolution clause ensures that the process is predictable, fair, and legally binding, thereby protecting the integrity of the fidelity bonding market and upholding the principles of good faith and fair dealing expected of all parties involved. It aligns with the regulatory expectation that disputes are resolved through established, transparent, and impartial channels. An incorrect approach would be to immediately resort to litigation, without first attempting to resolve the dispute through the policy's stipulated internal or alternative dispute resolution mechanisms. This is professionally unacceptable because it disregards the contractual terms agreed upon by both parties, potentially leading to unnecessary legal costs and delays. It also signals a lack of willingness to engage in good faith negotiation or mediation, which are often preferred methods for resolving such disputes efficiently and amicably. Furthermore, bypassing the agreed-upon dispute resolution process can be viewed as a breach of contract and may negatively impact the insurer's standing and the insured's ability to claim under the bond. Another incorrect approach is to accept the insurer's initial denial of the claim without further investigation or challenge, even if the insured believes the denial is unwarranted. This is professionally unsound, as it fails to advocate for the insured's rights and may result in the forfeiture of legitimate coverage. It neglects the principle that policyholders have a right to understand the basis of a claim denial and to seek recourse if they believe it is in error. A professional approach requires the insured to thoroughly review the denial, gather supporting evidence, and explore all available avenues for appeal or dispute resolution as outlined in the policy. A third incorrect approach would be for the insurer to unilaterally withdraw from communication with the insured after the initial denial, without providing a clear explanation or outlining the next steps in the dispute resolution process. This is ethically and professionally deficient, as it demonstrates a lack of transparency and a failure to engage in good faith communication. Insurers have a duty to act with reasonable promptness in investigating claims and to provide clear and understandable reasons for their decisions. Abandoning communication undermines the trust inherent in the insurance relationship and can lead to further complications and potential regulatory scrutiny. The professional decision-making process for similar situations should involve a systematic evaluation of the dispute. This includes a thorough review of the fidelity bond policy wording, all relevant documentation, and the specific circumstances of the claim. Professionals should then identify the most appropriate dispute resolution mechanism as defined by the policy and relevant regulations. This often involves exploring negotiation and mediation as initial steps before considering more formal processes like arbitration or litigation. Throughout the process, maintaining documented communication and acting in good faith are paramount to achieving a fair and legally compliant outcome. Question 10. Governance review demonstrates that a senior employee has been observed making unusual cash withdrawals from a company account, and there are discrepancies in recent expense reports that appear to be fabricated. What is the most appropriate immediate action to take regarding reporting mechanisms for suspected dishonesty, strictly adhering to the Fidelity Bonding Principles Certificate Framework? Option A. Discuss the observations informally with the suspected employee's direct manager to gauge their perspective before taking any formal action. Option B. Conduct a thorough, in-depth internal investigation to gather all evidence before reporting the suspicion to any internal or external parties. Option C. Immediately initiate the internal reporting protocol to the compliance department and simultaneously prepare a formal notification to the relevant regulatory authority as required by the Fidelity Bonding Principles Certificate. Option D. Report the suspicion directly to external law enforcement agencies to ensure a swift An official investigation. Correct answer is C. Immediately initiate the internal reporting protocol to the compliance department and simultaneously prepare a formal notification to the relevant regulatory authority as required by the Fidelity Bonding Principles Certificate. Explanation. This scenario presents a professional challenge because it requires an immediate and accurate response to a potential breach of trust and financial impropriety, while adhering strictly to the reporting mechanisms mandated by the Fidelity Bonding Principles Certificate framework. The challenge lies in balancing the need for swift action with the requirement for thoroughness and adherence to established procedures, ensuring that the integrity of the bonding process and the financial institution is maintained. Missteps in reporting can lead to regulatory sanctions, reputational damage, and a failure to protect against further losses. The correct approach involves initiating the internal reporting protocol immediately upon suspicion, followed by a formal notification to the relevant regulatory body as per the Fidelity Bonding Principles Certificate guidelines. This approach is correct because it prioritizes transparency and compliance. The Fidelity Bonding Principles Certificate framework, like many regulatory regimes, emphasizes proactive reporting of suspected dishonesty to enable timely investigation and mitigation of potential losses. Prompt internal reporting ensures that the organization's compliance and risk management functions are alerted, allowing for an immediate internal review and the preservation of evidence. Subsequent formal notification to the regulatory authority fulfills the explicit reporting obligations, demonstrating adherence to the principles of good governance and regulatory oversight inherent in fidelity bonding. An incorrect approach would be to delay reporting pending a complete internal investigation. This is professionally unacceptable because it risks the loss or destruction of crucial evidence, allows the suspected dishonest activity to continue unchecked, and potentially violates explicit reporting timelines stipulated by the Fidelity Bonding Principles Certificate. Furthermore, it undermines the principle of immediate disclosure that underpins effective fidelity bonding and regulatory oversight. Another incorrect approach would be to report the suspicion directly to external law enforcement without first following the internal reporting procedures and notifying the regulatory authority as required by the Fidelity Bonding Principles Certificate. A law enforcement involvement may eventually be necessary. Bypassing the established reporting channels can lead to procedural errors, incomplete information being presented to authorities, and a failure to meet the specific notification requirements of the Fidelity Bonding Framework. This can result in regulatory penalties and hinder the coordinated response that the framework is designed to facilitate. A third incorrect approach would be to dismiss the suspicion without any formal internal reporting, perhaps due to the perceived minor nature of the potential loss or the seniority of the individual involved. This is professionally unacceptable as it demonstrates a disregard for the principles of integrity and accountability central to fidelity bonding. All suspicions, regardless of perceived scale or the individual's position, must be investigated and reported through the designated channels to uphold the integrity of the system and prevent potential escalation of dishonest behavior. The professional decision-making process for similar situations should involve a clear understanding of the organization's internal policies and procedures for reporting suspected fraud or dishonesty, coupled with a thorough knowledge of the reporting obligations under the Fidelity Bonding Principles Certificate. Upon encountering a situation that raises suspicion, the professional should immediately consult these guidelines, initiate the internal reporting mechanism, and then proceed with the external notification to the regulatory body as mandated. This structured approach ensures that all regulatory requirements are met, internal controls are activated, and the integrity of the fidelity bonding process is upheld. Question 11. The performance metrics show an unusual spike in the number of high-value funds transfers initiated from a specific client account within a short period, with several of these transfers exhibiting characteristics often associated with social engineering scams. Which of the following represents the most appropriate immediate course of action for the firm's operational staff? Option A. Continue processing the funds transfers as usual, assuming the client is authorized to make these transactions, and monitor the account for further activity. Option B. Contact the client directly to inquire about the legitimacy of the recent funds transfers, advising them to be cautious of potential scams. Option C. Initiate an immediate internal audit of the client's account history and transaction patterns without notifying any other departments. Option D. Immediately escalate the suspicious activity to the firm's compliance and fraud investigation teams for review and further action, while temporarily placing a hold on further outgoing transfers from the account pending investigation. Correct answer is D. Immediately escalate the suspicious activity to the firm's compliance and fraud investigation teams for review and further action, while temporarily placing a hold on further outgoing transfers from the account pending investigation. Explanation: this scenario is professionally challenging because it requires balancing the immediate need to investigate a potential fraud with the imperative to maintain client trust and operational continuity. The firm must act decisively to protect its assets and clients while adhering strictly to regulatory requirements and ethical obligations. The speed and sophistication of funds transfer fraud necessitate a robust and well-defined response protocol. The correct approach involves immediate internal reporting and escalation to the appropriate compliance and security teams, followed by a thorough, documented investigation. This aligns with best practices for fraud prevention and detection, which emphasize prompt action and meticulous record-keeping. Regulatory frameworks, such as those governing financial institutions, mandate that firms have systems in place to detect and report suspicious activities, including fraudulent transactions. Prompt internal reporting ensures that the firm can initiate its fraud response plan, which typically includes steps like freezing accounts, gathering evidence, and notifying relevant authorities if necessary. This proactive stance is crucial for mitigating losses and demonstrating due diligence to regulators. An incorrect approach would be to delay reporting the suspicious activity internally, perhaps due to uncertainty about the severity or a desire to avoid causing alarm. This failure to promptly escalate could lead to significant financial losses and would violate regulatory obligations to maintain effective controls against financial crime. Another incorrect approach would be to directly contact the client to question the transaction without first consulting with the compliance department. This could compromise the investigation by tipping off potential fraudsters, alert innocent clients unnecessarily, and violate internal procedures designed to manage such sensitive situations. Furthermore, attempting to resolve the issue solely through the operational team without involving specialized fraud or compliance personnel risks overlooking critical regulatory requirements and investigative protocols. Professionals should employ a decision-making framework that prioritizes adherence to established internal policies and regulatory guidelines. This involves recognizing red flags, understanding reporting hierarchies, and acting with urgency, but also with due process. When faced with potential fraud, the immediate step should always be to follow the firm's documented fraud prevention and reporting procedures, which are designed to protect both the firm and its clients while ensuring compliance with all applicable laws and regulations. Question 12. The monitoring system demonstrates that a significant financial discrepancy has been identified within the company's overseas subsidiary, located in a territory not explicitly covered by the primary Fidelity bond policy. The internal audit report indicates the fraudulent activities leading to this discrepancy began approximately 3 years ago, during the initial term of the policy, but were only definitively discovered last month. Well within the policy's stated discovery period, the company is seeking to claim the full amount of the loss. Which of the following approaches best reflects the application of Fidelity bonding principles regarding policy territory and time period in this scenario? Option A. The claim should be assessed by prioritizing the date of the fraudulent acts, as the loss originated during the policy term, and the discovery period is primarily to prevent stale claims, rather than to limit coverage for acts that occurred within the policy's original duration. Option B. The claim should be assessed by focusing on the intent of the policy to cover employee dishonesty, assuming the territorial limitation is a minor detail that can be waived given the significant loss, and the fact that the acts began during the policy term. Option C. The claim should be assessed by confirming that both the fraudulent acts and the discovery of the loss occurred within the defined policy territory and the applicable discovery period, as stipulated in the Fidelity bond. Option D. The claim should be assessed based on whether the loss was discovered within the policy's discovery period, as the fraudulent acts originated during the policy term, and the location of the subsidiary is secondary to the discovery date. The correct answer is D. The claim should be assessed based on whether the loss was discovered within the policy's discovery period, as the fraudulent acts originated during the policy term, and the location of the subsidiary is secondary to the discovery date. Explanation. This scenario presents a professional challenge because it requires a nuanced understanding of how policy territory and time period limitations interact with the discovery of a fidelity loss. The challenge lies in accurately determining when a loss is considered discovered for the purpose of triggering coverage under a fidelity bond, especially when the loss may have occurred over an extended period and across different geographical locations. Careful judgment is required to avoid misinterpreting the policy scope and to ensure that the insured party receives appropriate coverage without overextending the insurer's liability beyond the policy's defined parameters. The correct approach involves meticulously examining the policy's territory and time period clauses in conjunction with the date of discovery of the loss. This means confirming that the fraudulent acts occurred within the defined policy territory and that the discovery of the loss falls within the discovery period stipulated by the bond. Specifically, if the policy defines territory as all business operations within the United Kingdom, and the fraudulent activity occurred in a branch located in France, then that portion of the loss would likely be excluded. Similarly, if the bond states that a loss must be discovered within a certain number of years after the policy period ends, and the discovery occurs outside this window, coverage may be denied. This approach aligns with the fundamental principles of fidelity bonding, which are to indemnify the insured against direct financial loss resulting from fraudulent or dishonest acts committed by employees, but only within the agreed-upon geographical and temporal boundaries of the policy. The regulatory framework for fidelity bonds, as governed by the Financial Conduct Authority, FCA in the UK, and interpreted through industry best practices and case law, emphasizes the importance of clear contractual terms regarding territory and time. An incorrect approach would be to assume coverage simply because a loss has occurred and has been discovered, without verifying the geographical location of the fraudulent acts. This fails to acknowledge the explicit territorial limitations that are a cornerstone of fidelity bond contracts. Such a failure could lead to the insurer being held liable for losses that fall outside the agreed-upon scope of coverage, potentially exposing them to significant unmanaged risk. Another incorrect approach is to focus solely on the date of the fraudulent act and overlook the discovery period. Fidelity bonds typically have a discovery clause, meaning the loss must be discovered within a specified time frame, even if the act occurred during the policy period. Ignoring this discovery period can lead to disputes and claims being incorrectly paid or denied. A third incorrect approach is to interpret discovery too broadly, for instance, by considering the first inkling of suspicion, rather than the point at which the insured has sufficient information to reasonably conclude that a loss has occurred due to employee dishonesty. This can lead to premature claims or, conversely, the denial of valid claims if the insurer argues the loss was discoverable earlier. The professional decision-making process for similar situations should involve a systematic review of the fidelity bond policy documents, paying close attention to the definitions of insured, employee, loss, territory, and discovery period. It requires gathering all relevant facts about the alleged fraudulent acts, including their timing and location, and comparing them against the policy terms. When in doubt, seeking clarification from legal counsel or experienced underwriting professionals specializing in fidelity bonds is crucial. The process should prioritize adherence to the contractual terms and the spirit of the insurance contract, ensuring fairness to both the insured and the insurer. Question 13. Compliance review shows that a firm has implemented a new automated reconciliation system for client assets. The system is designed to perform daily reconciliations and flag discrepancies. The head of operations proposes reducing the frequency of independent internal audits of these reconciliations from quarterly to annually, citing the efficiency and accuracy of the new automated system. What is the most appropriate course of action? Option A. Increase the frequency of automated system checks to twice daily and consider this sufficient oversight, eliminating the need for independent internal audits. Option B. Maintain quarterly independent internal audits of client asset reconciliations, supplementing the automated system's checks with targeted manual reviews and ongoing validation of the automation's effectiveness. Option C. Reduce independent internal audits to annually, relying primarily on the automated system's daily reports and only conducting ad hoc reviews if significant discrepancies are flagged. Option D. Discontinue independent internal audits altogether, as the automated system is deemed sufficiently reliable and compliant with regulatory requirements. The correct answer is B. Maintain quarterly independent internal audits of client asset reconciliations, supplementing the automated system's checks with targeted manual reviews and ongoing validation of the automation's effectiveness. Explanation: this scenario presents a professional challenge because it requires balancing the efficiency of a new system with the absolute necessity of maintaining robust internal controls and regulatory compliance. The firm has implemented a new automated reconciliation system, which, while promising efficiency gains, introduces a new layer of risk if not adequately validated and monitored. The core of the challenge lies in ensuring that the automation does not inadvertently create blind spots or bypass critical checks that are fundamental to Fidelity bonding principles and regulatory expectations. Careful judgment is required to assess the effectiveness of the new system's audit trails and reconciliation processes against established standards. Correct approach involves a comprehensive, ongoing validation and testing of the automated reconciliation system, coupled with periodic manual checks and independent audits. This approach is correct because it directly addresses the regulatory requirement for robust internal controls and accurate record keeping, which are paramount in Fidelity bonding. The Financial Services and Markets Act 2000 FSMA and associated FCA Handbook, specifically. For example, SISC 3.1.1R on systems and controls mandate that firms have adequate systems and controls in place to safeguard client assets and prevent financial crime. Regular, independent audits and reconciliation processes, even with automation, are essential to detect errors, fraud, or system malfunctions. This ensures that the firm can demonstrate compliance with its obligations to clients and regulators, providing assurance that assets are properly managed and protected. An incorrect approach would be to solely rely on the automated system's output without independent verification. This fails to meet the regulatory expectation for independent oversight and validation of critical financial processes. The FCA Handbook, particularly in sections related to client money and asset safeguarding, emphasizes the need for controls that are not solely dependent on automated processes, as these can be susceptible to programming errors or manipulation. Another incorrect approach would be to reduce the frequency of manual reconciliation or sampling simply because a new automated system is in place. This overlooks the principle that automation is a tool to enhance, not replace, fundamental control mechanisms. Regulatory expectations often require a layered approach to controls, where automated processes are supplemented by human oversight and periodic independent checks to provide a higher level of assurance. The absence of such supplementary checks creates a significant regulatory and ethical failure, as it increases the risk of undetected discrepancies or fraudulent activities. A further incorrect approach would be to assume the system is infallible and to only conduct audits when a specific issue is flagged by the automated system. This reactive stance is contrary to the proactive risk management expected by regulators. Fidelity bonding principles and regulatory frameworks emphasize a preventative and detective control environment. Relying solely on the system to flag issues means that any errors or fraudulent activities that bypass the automated detection mechanisms would go unnoticed, leading to potential client losses and regulatory breaches. The professional decision-making process for similar situations should involve a risk-based assessment of any new system or process. This includes understanding the inherent risks, identifying existing controls, and determining if new or enhanced controls are necessary to mitigate those risks to an acceptable level. Professionals must consult relevant regulatory guidance, e.g., FCA Handbook, relevant guidance from the Financial Ombudsman Service, and internal policies to ensure that proposed changes align with compliance obligations. A critical step is to involve internal audit or an independent third party early in the implementation phase to validate the effectiveness of new controls, and to establish a schedule for ongoing monitoring and testing that meets regulatory standards. Question 14. Process analysis reveals that a company has recently appointed a new individual to a position that involves handling significant financial assets. The company currently holds a named schedule bond that lists specific employees and their respective coverage amounts. What is the most appropriate action to ensure compliance with the Fidelity Bonding Principles Certificate's requirements regarding listed employees? Option A. Wait until the end of the fiscal quarter to update the named schedule bond to include the new employee. Option B. Rely on the fact that the new employee has undergone a background check, which implicitly provides sufficient coverage. Option C. Assume the new employee is covered under a general blanket provision within the Fidelity insurance policy. Option D. Immediately add the new employee's name and coverage amount to the existing name schedule bond, confirming with the underwriter. The correct answer is D. Immediately add the new employee's name and coverage amount to the existing name schedule bond, confirming with the underwriter. Explanation. This scenario is professionally challenging because it requires a nuanced understanding of how name schedule bonds operate within the regulatory framework of fidelity bonding, specifically concerning the identification and coverage of listed employees. The core difficulty lies in accurately determining whether a newly appointed individual falls under the existing schedule or necessitates an amendment, balancing operational efficiency with regulatory compliance and risk management. Careful judgment is required to avoid potential coverage gaps or unnecessary premium increases. The correct approach involves a thorough review of the existing name schedule bond and the employment status of the individual in question. This approach is right because it directly addresses the principle of specific employee coverage inherent in name schedule bonds. Regulatory guidelines for fidelity bonding, such as those governing the Fidelity Bonding Principles Certificate, mandate that such bonds list specific individuals and the amounts for which they are insured. When a new employee assumes a role that requires fidelity coverage, the employer must assess if that role is already covered by the schedule or if the individual needs to be added. This proactive verification ensures that coverage remains accurate and compliant with the bond's terms and conditions, preventing potential uninsured losses. An incorrect approach would be to assume the new employee is automatically covered under a general blanket provision, or that their role is implicitly covered without explicit confirmation. This fails to adhere to the fundamental principle of name schedule bonds, which are designed for named individuals. Regulatory frameworks emphasize clarity and specificity in insurance contracts. Assuming coverage without verification creates a significant compliance risk and a potential for uncovered claims, which is a direct violation of the principles of sound risk management and insurance practice. Another incorrect approach would be to delay the process of updating the schedule, continuing operations with the assumption that coverage will be retroactively applied. While some policies may offer limited retroactive coverage, relying on this without proper notification and amendment is a breach of the contractual obligations between the insured and the insurer. It exposes the employer to significant financial risk if a loss occurs before the schedule is updated, and can lead to disputes with the insurer, potentially invalidating coverage for the period of noncompliance. This demonstrates a failure to understand the importance of timely and accurate reporting in maintaining the integrity of the fidelity bond. The professional decision-making process for similar situations should involve a systematic review of the name schedule bond's terms and conditions, a clear understanding of the roles and responsibilities of newly appointed employees, and a proactive communication protocol with the fidelity bond underwriter or broker. This protocol should trigger an immediate assessment of whether the new employee needs to be added to the schedule, ensuring that all coverage requirements are met before the employee commences their duties in a position requiring fidelity protection. Question 15. What factors determine whether an individual performing services for a financial firm is considered an employee for the purposes of mandatory fidelity bonding under UK regulations? Option A. Whether the individual is listed on the firm's payroll for tax purposes. Option B. The individual's professional qualifications and experience. Option C. The nature of the services performed and the degree of control the firm exercises over the individual, irrespective of their formal employment status. Option D. Whether the individual has a formal employment contract with the firm. The correct answer is C. The nature of the services performed and the degree of control the firm exercises over the individual, irrespective of their formal employment status. Explanation. This scenario is professionally challenging because the definition of employee for fidelity bonding purposes can be nuanced and extend beyond traditional employment relationships. Misinterpreting this definition can lead to significant regulatory noncompliance and financial exposure for the firm. Careful judgment is required to ensure all individuals performing duties that could expose the firm to loss through dishonesty are appropriately covered. The correct approach is to consider the substance of the relationship and the potential for dishonest acts, rather than solely relying on the formal title or contractual arrangement. This aligns with the principle of ensuring adequate protection against fidelity losses, which is the core purpose of fidelity bonding. Regulatory frameworks typically define employee broadly to encompass individuals acting on behalf of the firm in a capacity that could lead to financial harm if they act dishonestly. This ensures that the bond provides comprehensive coverage. An incorrect approach would be to limit coverage only to individuals with a formal employment contract. This fails to acknowledge that independent contractors, consultants, or even temporary staff can perform roles that, if executed dishonestly, could result in losses to the firm. Such a narrow interpretation would leave the firm underinsured and in violation of regulatory expectations for robust fidelity protection. Another incorrect approach is to assume that any individual not on the company payroll is automatically excluded from coverage. This overlooks the fact that the intent of fidelity bonding is to protect against loss arising from dishonest acts by those entrusted with the firm's assets or responsibilities, regardless of their employment status. The focus should be on the function and the risk, not just the employment classification. A third incorrect approach is to rely solely on the advice of an insurance broker without independent verification of the definition of employee within the relevant regulatory framework. While brokers provide valuable expertise, the ultimate responsibility for compliance rests with the firm. Failing to understand and apply the regulatory definition directly can lead to significant oversights. Professionals should adopt a decision-making framework that prioritizes understanding the regulatory definition of employee as it pertains to fidelity bonding. This involves reviewing the specific wording in the relevant legislation and guidance, considering the nature of the work performed by all individuals associated with the firm, and assessing the potential for financial loss due to dishonest acts. When in doubt, seeking clarification from the regulator or legal counsel is advisable. Question 16. Examination of the data shows an employee receives an urgent phone call from someone claiming to be a senior executive requesting immediate transfer of funds to a new supplier account. The caller states that the executive is in a critical meeting and cannot be reached through normal channels, emphasizing the need for speed and discretion. The employee has never dealt with this specific executive before, and the request is outside of the usual process for setting up new suppliers. What is the most appropriate course of action? Option A. Politely decline the request, stating that the employee cannot fulfill it due to the unusual nature of the request and lack of prior contact. Option B. Immediately process the fund transfer as requested, given the urgency and the purported authority of the caller. Option C. Attempt to verify the executive's identity and the legitimacy of the request through an independent and pre-established communication channel before taking any action. Option D. Forward the request to a colleague for their opinion and potential action, as the employee is unsure how to proceed. The correct answer is B. Immediately process the fund transfer as requested, given the urgency and the purported authority of the caller. Explanation. This scenario is professionally challenging because it involves a direct attempt to bypass established security protocols through manipulation, a common tactic in social engineering. The employee is faced with an urgent request from someone impersonating a senior executive, creating pressure to act quickly and potentially overlook standard procedures. The core of the challenge lies in distinguishing a legitimate, albeit unusual, request from a fraudulent one, especially when the request appears to come from a position of authority. Careful judgment is required to uphold security principles without appearing obstructive to genuine business needs. The correct approach involves verifying the identity of the requester through an independent and pre-established communication channel. This upholds the principle of due diligence and adherence to internal security policies designed to prevent unauthorized access and fraudulent transactions. Specifically, the Fidelity Bonding Principles Certificate, in line with regulatory expectations for financial institutions, mandates robust internal controls and verification procedures to safeguard assets and client information. Relying on an unsolicited or unverified communication channel for sensitive instructions, even if seemingly from a senior figure, is a direct violation of these principles. The regulatory framework emphasizes a culture of skepticism and verification, particularly when dealing with requests that deviate from normal operating procedures or involve financial transactions. An incorrect approach would be to immediately comply with the request based solely on the perceived authority of the caller and the urgency of the situation. This fails to acknowledge the inherent risks of social engineering and bypasses essential security checks. Such an action would be a direct contravention of the principles of safeguarding assets and maintaining data integrity, which are fundamental to fidelity bonding and regulatory compliance. Another incorrect approach would be to dismiss the request outright without any attempt at verification. While caution is necessary, a complete refusal without attempting to confirm the legitimacy of the request could impede legitimate business operations and damage professional relationships. It fails to balance security with operational efficiency. Professionals should employ a decision-making framework that prioritizes verification. When faced with an unusual or urgent request, especially one that involves sensitive information or financial actions, the first step should always be to independently verify the requester's identity using a known and trusted contact method, e.g., a direct call to a known number, an internal messaging system, or a face-to-face interaction. If verification confirms the request is legitimate, then proceed according to established procedures. If verification fails or is impossible, the request should be politely declined, and the incident reported to the appropriate security or compliance department. This systematic approach ensures that security protocols are maintained, while allowing for the efficient handling of genuine business needs. Question 17. When evaluating potential coverage for a commercial entity experiencing employee dishonesty losses, and considering the entity holds multiple Fidelity insurance policies, what is the most appropriate method to determine which policy or policies should respond to the claim? Option A. Conduct a detailed review of all existing Fidelity bond policies, focusing on the specific insuring agreements, definitions of employee and employee dishonesty, applicable endorsements, exclusions, and policy limits to ascertain which policy's terms and conditions most accurately align with the nature and circumstances of the loss. Option B. Assume that the most recently purchased Fidelity bond will automatically provide coverage, as it is presumed to be the most up-to-date reflection of the entity's insurance needs. Option C. Rely on general industry knowledge and common practices regarding Fidelity bond coverage for commercial entities to make an informed decision about which policy is most likely to apply. Option D. Prioritize the Fidelity bond with the highest aggregate limit of liability, as this is generally intended to cover the most significant potential losses. The correct answer is A. Conduct a detailed review of all existing Fidelity bond policies, focusing on the specific insuring agreements, definitions of employee and employee dishonesty, applicable endorsements, exclusions, and policy limits to ascertain which policy's terms and conditions most accurately align with the nature and circumstances of the loss. Explanation. This scenario is professionally challenging because it requires a nuanced understanding of how different types of commercial blanket bonds respond to various Fidelity losses, particularly when multiple policies might be in play or when the scope of coverage is not immediately clear. The core difficulty lies in accurately identifying which bond, or combination of bonds, is intended to cover the specific type of loss experienced by the commercial entity, and to what extent. This demands careful interpretation of policy language, understanding of exclusions, and awareness of the entity's operational structure. The correct approach involves a thorough review of the commercial entity's existing Fidelity bond policies, specifically focusing on the terms and conditions of their commercial blanket bonds. This includes examining the insuring agreements, definitions of employee, employee dishonesty, and any applicable endorsements or exclusions. The analysis must determine if the loss falls within the scope of coverage as defined by the bond, considering the nature of the dishonest act, the perpetrator's status as an employee, and the policy limits. This approach is correct because it adheres strictly to the contractual obligations and regulatory intent of Fidelity Insurance, ensuring that claims are processed based on the agreed-upon coverage and not on assumptions or external factors. It prioritizes accurate policy interpretation and application, which is a fundamental ethical and regulatory requirement in the insurance industry. An incorrect approach would be to assume that any loss caused by an employee is automatically covered by the most comprehensive or recently purchased bond, without a detailed review of all relevant policies. This fails to acknowledge that different bonds may have varying scopes of coverage, limits, and exclusions, and that the entity might hold multiple, potentially overlapping or sequential Fidelity policies. This approach risks misapplying coverage, potentially leading to underpayment or denial of valid claims, which violates the principle of good faith and fair dealing with the insured. Another incorrect approach would be to focus solely on the monetary amount of the loss and immediately seek to apply the bond with the highest limit, irrespective of whether the loss event aligns with the specific perils insured under that bond. This overlooks the critical aspect of coverage matching. A bond with a high limit might have specific exclusions or definitions that render it inapplicable to the particular type of employee dishonesty that occurred. This can lead to a wrongful denial of a claim that should have been covered by a different, perhaps lower limit bond that was specifically designed for such events. A third incorrect approach would be to rely on anecdotal evidence or industry hearsay regarding typical coverage for commercial entities without consulting the actual policy documents. Fidelity bond coverage is highly specific to the policy wording. Relying on general assumptions can lead to significant errors in judgment, potentially causing the commercial entity to believe they are covered when they are not, or vice versa. This demonstrates a lack of due diligence and a failure to uphold professional standards in assessing insurance needs and coverage. A professional decision-making process for similar situations should involve a systematic review of all relevant fidelity bond policies held by the commercial entity. This includes identifying the type of bond, e.g., commercial blanket bond, blanket position bond, the policy period, the insuring agreements, definitions, exclusions, and limits. A comparative analysis of how each policy addresses the specific type of loss, the alleged perpetrator's role, and the timing of the loss is crucial. If there is ambiguity, seeking clarification from the underwriter or legal counsel specializing in fidelity insurance is a prudent step. The ultimate goal is to ensure that the correct policy or combination of policies is identified to provide the intended coverage, thereby fulfilling the contractual and ethical obligations to the insured. Question 18. Quality control measures reveal a significant financial discrepancy within a bank's trading department, attributed to a series of unauthorized trades executed by a senior trader over several months. The bank's fidelity bond policy has a specific clause covering losses resulting directly from dishonest acts committed by employees. Which of the following approaches best aligns with the principles of fidelity bonding for financial institutions in this scenario? Option A. Immediately file a claim under the fidelity bond, detailing the total financial loss, assuming the policy will cover all losses stemming from employee actions. Option B. Consider the financial discrepancy as a general operational risk and explore other insurance policies, as fidelity bonds are typically for smaller, isolated incidents of theft. Option C. Conduct a detailed internal investigation to confirm the unauthorized trades were indeed dishonest acts by the employee, and then assess the loss against the specific coverage and exclusions outlined in the fidelity bond policy before filing a claim. Option D. Negotiate a repayment plan with the employee and only consider a fidelity bond claim if the employee is unable to repay the full amount, as this is a secondary recourse. Correct answer is A. Immediately file a claim under the fidelity bond, detailing the total financial loss, assuming the policy will cover all losses stemming from employee actions. Explanation: this scenario is professionally challenging because it requires a nuanced understanding of how fidelity bond coverage applies to the unique operational risks faced by financial institutions, specifically banks and credit unions. The core challenge lies in accurately identifying and classifying potential losses to ensure appropriate coverage is in place, thereby protecting both the institution and its customers from financial harm due to employee dishonesty or operational errors. Misinterpreting the scope of coverage can lead to significant financial exposure and regulatory noncompliance. The correct approach involves a thorough review of the institution's internal controls and risk management processes to determine if the reported incident falls within the defined parameters of the fidelity bond policy. This requires understanding the specific exclusions and inclusions within the policy, particularly concerning acts of employee dishonesty versus operational failures or third-party fraud. By meticulously examining the nature of the loss against the policy's terms, the institution can accurately assess its claim and ensure it is processed correctly. This aligns with the regulatory expectation for financial institutions to maintain robust internal controls and to act prudently in managing their financial risks, as mandated by prudential regulators who oversee the safety and soundness of these entities. An incorrect approach that focuses solely on the financial loss amount, without considering the cause or the policy's specific definitions would be professionally unacceptable. This failure stems from a lack of due diligence in understanding the Fidelity bond's coverage, potentially leading to an invalid claim and a failure to recover losses that should have been covered. This demonstrates a disregard for the contractual obligations of the insurance policy and a potential breach of fiduciary duty to the institution. Another incorrect approach that assumes all financial losses are automatically covered by a Fidelity bond, regardless of the cause, is also professionally unsound. Fidelity bonds are designed to cover specific perils, primarily employee dishonesty. Broadly interpreting coverage to include all financial shortfalls, such as those arising from market fluctuations or systemic failures, would be a misapplication of the policy and a failure to adhere to its contractual limitations. This can lead to a false sense of security and inadequate risk mitigation strategies. Furthermore, an approach that prioritizes expediency over accuracy by immediately filing a claim without a proper internal investigation into the root cause of the loss is problematic. This haste can lead to inaccurate reporting, potentially jeopardizing the claim, and demonstrating a lack of professional diligence in managing the institution's insurance assets. It also fails to uphold the principle of acting with integrity and thoroughness in all business dealings. The professional decision-making process for similar situations should involve a systematic approach. 1. Understand the specific Fidelity bond policy, including all endorsements, exclusions, and definitions. 2. Conduct a thorough internal investigation to determine the precise cause and nature of the loss. 3. Compare the findings of the investigation with the terms and conditions of the Fidelity bond. 4. Consult with legal counsel and insurance brokers or underwriters if there is any ambiguity regarding coverage. 5. File a claim only after a clear determination that the loss is covered under the policy, providing all necessary documentation and information. 6. Maintain clear and accurate records of all communications and decisions related to the claim. Question 19. Process analysis reveals that a financial services firm is preparing to transport a significant portfolio of bearer bonds from one vault location to another, utilizing a third-party armored car service. The firm's current Fidelity bond policy covers losses due to employee dishonesty and direct physical loss at its insured premises. The firm has not specifically reviewed its policy for in-transit coverage for this type of asset. Which of the following actions best ensures adequate protection for the bearer bonds during this transportation? Option A. Assuming the existing Fidelity bond policy implicitly covers losses occurring during transit, as it is a standard practice for such policies. Option B. Obtaining a separate, limited coverage transit insurance policy that only covers a fraction of the bearer bond's value to minimize premium costs. Option C. Confirming with the armored car service that their insurance adequately covers the value of the bearer bonds. Option D. Verifying that the firm's Fidelity bond policy includes an endorsement or specific provision for in-transit coverage of bearer bonds for the intended route and duration. Correct answer is C. Confirming with the armored car service that their insurance adequately covers the value of the bearer bonds. Explanation. This scenario presents a professional challenge in ensuring adequate Fidelity bond coverage for valuable assets during their physical movement. The core difficulty lies in accurately assessing the risk associated with in-transit transportation and selecting the appropriate bond provisions to mitigate potential losses due to theft, damage, or disappearance. Professionals must exercise careful judgment to balance the cost of coverage against the potential financial impact of a loss. The correct approach involves verifying that the existing Fidelity bond policy explicitly includes or can be endorsed to cover in-transit risks for the specific types of assets being transported and for the defined routes and duration. This ensures that the bond's insuring agreement extends to cover losses occurring while the assets are under the care, custody, and control of third-party carriers or employees during transit. Regulatory frameworks, such as those governing financial institutions and asset management, often mandate that firms maintain adequate insurance to protect client assets against various risks, including those during transportation. Ethical considerations also demand that firms act prudently to safeguard assets entrusted to them, which includes securing appropriate coverage for all stages of asset handling, including transit. An incorrect approach would be to assume that standard Fidelity bond coverage automatically extends to in-transit risks without explicit confirmation. Many Fidelity bonds are designed to cover losses arising from employee dishonesty or direct physical loss occurring at specified premises. Relying on such a policy without verifying in-transit coverage could lead to a significant gap in protection, leaving the firm and its clients exposed to uninsured losses. This failure to conduct due diligence on policy scope constitutes a breach of professional duty and potentially violates regulatory requirements for asset protection. Another incorrect approach is to solely rely on the carrier's insurance to cover in-transit losses. While carriers typically have their own insurance, the limits, exclusions, and claim processes may not align with the firm's needs or the value of the assets. The firm remains ultimately responsible for the safeguarding of client assets, and delegating this responsibility without ensuring comprehensive coverage through its own Fidelity bond is a regulatory and ethical failing. This approach neglects the principle of direct responsibility for asset security. A further incorrect approach is to opt for a minimal level of in-transit coverage to reduce premium costs without a thorough risk assessment. This decision prioritizes cost savings over adequate protection, potentially exposing the firm to substantial financial losses that could jeopardize its solvency and reputation. Regulatory bodies expect firms to make informed decisions based on risk, not solely on cost, to ensure the financial stability and integrity of the operations. The professional decision-making process for similar situations should involve a systematic review of the Fidelity bond policy's terms and conditions, specifically focusing on ensuring agreements, exclusions, and endorsements related to property in transit. This should be coupled with a comprehensive risk assessment of the transportation process, considering the nature of the assets, the value, the mode of transport, the carriers involved, and the geographical routes. Consultation with the Fidelity bond underwriter or an experienced insurance broker is crucial to confirm coverage adequacy and explore options for endorsements or separate transit policies if necessary. The ultimate decision must prioritize the protection of assets and compliance with all applicable regulations and ethical standards. Question 20. Regulatory review indicates that a financial services firm has discovered a significant financial loss stemming from unauthorized trading activities conducted by a senior trader. The firm holds a comprehensive blanket Fidelity bond that covers all employees. The loss was discovered during a routine internal audit, and the unauthorized trades occurred over a period of several months prior to discovery. The firm's compliance department is considering how to proceed with a potential claim under the bond. Which of the following approaches best aligns with the principles of fidelity bonding and regulatory expectations for managing such a situation? Option A. Assume the loss is fully covered under the blanket bond due to the broad employee coverage and proceed with internal adjustments to account for the loss without notifying the underwriter. Option B. Conduct a preliminary internal assessment to determine if the unauthorized trading constitutes a dishonest act as defined by the bond, and if the discovery falls within the policy's discovery period before formally notifying the underwriter. Option C. Immediately submit a claim to the Fidelity bond underwriter, detailing the loss and the unauthorized trading activities, and cooperate fully with the underwriter's investigation. Option D. Delay reporting the loss to the Fidelity bond underwriter until a more comprehensive understanding of the full extent of the financial impact is established, to avoid multiple claim submissions. The correct answer is C. Immediately submit a claim to the Fidelity bond underwriter, detailing the loss and the unauthorized trading activities, and cooperate fully with the underwriter's investigation. Explanation: this scenario is professionally challenging because it requires a nuanced understanding of the scope and limitations of Fidelity bond coverage, specifically in the context of a broad employee base. The firm's reliance on a blanket bond, while generally offering the widest coverage, necessitates careful consideration of whether the discovered loss falls within the policy's defined terms and conditions, particularly concerning employee acts and the discovery clause. The firm must balance the need for swift resolution and potential recovery with the contractual obligations and reporting requirements stipulated by the Fidelity bond. The correct approach involves a thorough investigation to determine if the loss was caused by an employee acting in their capacity as an employee, and if the discovery of the loss aligns with the policy's discovery period. This approach is justified by the fundamental principles of fidelity bonding, which are designed to protect against financial loss due to dishonest acts of employees. Adhering to the policy's terms, including the discovery clause, is paramount for a valid claim. Furthermore, prompt and accurate reporting to the underwriter, as typically required by fidelity bond policies, is a critical regulatory and contractual obligation. An incorrect approach would be to assume coverage solely based on the blanket nature of the bond, without verifying the specific cause of loss and its relation to employee dishonesty as defined by the policy. This fails to acknowledge that even broad policies have exclusions and conditions. Another incorrect approach would be to delay reporting the loss to the underwriter, potentially jeopardizing the claim under the discovery clause and violating policy conditions. A third incorrect approach would be to unilaterally decide the loss is covered and proceed with reimbursement without consulting the policy or the underwriter, which bypasses the claims process and could lead to denial. Professionals should approach such situations by first meticulously reviewing the Fidelity bond policy, paying close attention to definitions of employee, dishonest acts, and the discovery clause. They should then conduct a thorough internal investigation to gather evidence supporting the cause and timing of the loss. Following this, they must consult with their Fidelity bond underwriter or a specialist to interpret the policy in light of the investigation findings and to understand the claims submission process. This structured approach ensures compliance with policy terms and regulatory expectations, maximizing the likelihood of a successful claim while mitigating risks.